Hi everyone, this is going to be an end of day Emini review over Monday, December the 12th. And when you're looking at this day, the single most important thing to realize on the open is right here. This initial trading range open. And let me just adjust a few things. So on the open, better yet, let me ignore anyways. There's new features on Snagit that are kind of neat. You can draw things and they'll disappear, but it's a little distracting. So anyways, today was a small pullback trend day, and it was actually a very interesting day because here the market formed a very tight trading range on the open. And by the way, whenever I'm watching the market or trading, I typically don't keep this many bars on the chart. This computer, when I actually watch the market on, I guess the settings, the bars are smaller. So, normally, I wouldn't have that many bars. But the point is, overall, let me make a few adjustments here. And this kind of be more of an informal video, just over the day. So the market formed a triangle on the open, and it's triangle from basically here to here. So it's forming a triangle. And whenever you get a triangle, it's breakout mode. At this point, the market broke to the upside, ending this structure. So now you have a breakout of a trading range, a breakout of a triangle. You have targets above from the prior day over here in this area. So you get a breakout and follow through. It's by the close. Now the one thing you have to be aware about is, yes, it's a strong enough breakout. You're going to get 2 or 3 legs up, but you could easily form a trending trading range and the market would go sideways. So trading range here, upside breakout. What do I think is most likely? I think that we're going to get some kind of trading range over here over the next several bars. And the bears that sell here and scale in higher are probably going to make money. Now, most of those bears selling here, most traders should exit 3 consecutive bull bars, micro channel, with bodies getting bigger, this bar closing above all the bars to the left. Most traders should exit on this bar, certainly as this bar turns up. And the reason for that is there's too much risk you're going to get a second leg up. Some bears will sell up here and wait for a bear bar, such as right here. And maybe they sell, and they sell more below this bar right here. And you can see they got out break even here. But nonetheless, it is a breakout and the market goes sideways. Now what you notice here is right here. This is important. This gap stayed open. And when that happens, it increases the risk of a possible small pullback trend day. The market breaks to the upside. The bears, they make a little bit of money here, maybe on a scalp, but they fail to make money below bars on any of these bars. And right here, the market's forming a wedge. You can argue 1, 2, 3, 1 on bar 24, 31, and 39. You could also argue that it's bar 20, 24, and 31. And this is the second. This is a failed breakout. But what do you notice? 3 consecutive bull bars, 3 consecutive bull bars, lots of bull bars closing on their highs. At this point, you have a wedge with bar 39, reasonable for traders to exit here. And you can see it went outside up, got a second entry short, and then we had a big outside down bar. So the point I'm making is you have a wedge, it's probably going to convert into a trading range here. And overall, the market forms a couple legs down. Leg 1, pullback, leg 2, breakout, pullback, buy setup. And instead of selling off, testing down here, the market formed a double bottom with 19, or you can call it a higher low, double bottom, 36 and 46, and the market drifts to the upside. And rather than, I'm going to speed this up, then I'll go over each bar real quick, but anyways, it broke to the upside and just kept rallying for the rest of the day. So let's go bar by bar for just a minute. First bar of the day, bear bar, closing on its low. Some traders will sell below it, but big down, big rally, strong enough breakout, you'll probably get a second leg, maybe up. The gap up is an upside breakout. The other problem with selling below bar 1 is it's a low probability trade. Probably more buyers below. Better to wait for consecutive bear bars. Now we have consecutive bear bars closing on their lows, possibly always in short and sell the close. You can take it. You can sell the close, betting on a second leg down. The problem you have is if you're selling here, you're selling into support. You're selling after a fairly climactic sell-off, consecutive sell climaxes here, test of yesterday's close, probably more buyers down here than sellers. It's possible that the market at least has a second leg down, but big rally on this tail, big rally here. I think the market's going to go sideways rather than straight down. And bull bar closing on its high. So bull bar closing on its high, I would get out of shorts above 3. It's pretty aggressive to buy above 3. Too much risk, you're going to get a second leg down, and it may just be a retest of 1. But certainly reasonable to exit shorts above 3, and that's why. You can see traders sold the close of 2, and they were disappointed on 3. Look what they did on bar 4. Those bears tried their best. Those bears tried to get out at the close of bar 2. Whenever you see the market start to turn up rather quickly, and you're short, better look to sell, better to look to buy back shorts. What about bar 4? Is it a decent buy? It's consecutive bull bars. It's okay. You can take it for a swing. The problem I have with this open is it's pretty similar to yesterday. Rally up, rally down. So sell off, rally. Probably going more sideways than straight up or straight down. But you could take the buy, stop below 4, 3, or 2, betting on a second leg up. And there's your disappointment, bar 5. Bar 5 is a double top with bar 1. Some traders will exit below bar 5. Too much risk of double top. And other traders will wait for a consecutive bear bar. So if you hold long below 5, you wait, and if you get a second bear bar like this, you exit. Otherwise, you stay long, stop below here. And the bar never triggered. So bull bar trying to break above these highs. Possible micro wedge, 1, 2, 3, but obviously it's a 5-bar micro channel. And even bar 5 is a 4-bar micro channel. So probably buyers below and at least a little bit higher. And a doji bar on 6. So wedge, 1, pullback, 2, pullback, 3. But doji bar below 6. Some traders will exit doji on 7. Some traders will exit below 7. Others will wait for a bear bar closing on its low. Another doji, breakout below 7, but failed to close below 7. Probably buyers below and going at least a little bit higher. 20 gap bar sell if you include this. And, I know this bar touched it, so you can argue it's not, but this is the first close above the moving average since over here. So there might be more sellers up here. There might be more sellers up here than buyers. Now you have 3 consecutive bear bars. And a lot of traders, it's reasonable to exit below 9 or the close of 9 and look for and wait. Too much risk of a downside breakout. Other traders, instead of exiting on the close of 9, would exit below 9, betting that 9 may be a trap, and trap bulls out of a buy, and trap bears into a bad short. And there you go. So the market triggered below 9. And I want to say one thing about this. Whenever you get, it's reasonable to hold below here and wait for a bear bar closing on its low. You don't get one, but then you get a third bar, and now you have a 3-bar micro channel, increasing the odds of a small second leg down. That's why a lot of traders exit below 9. Too much risk. This is going to be a reversal, and you may come all the way down here. So 10, big bear bar, 4-bar micro channel. Now you've had 2-bar sell-off, a rally, and then a sell-off, probably sideways and forming a tight trading range. And then you get a bull bar on 11. Traders will buy it, betting that it's a higher low, and we're going to get an upside breakout. Dangerous to buy after this tight of a channel, though. You may get a pullback down to here. So other traders, instead of buying above 11, will look to buy a pullback of 11. You can see right here, this is 50%. So traders, it's a bad entry bar on 12. Traders will buy the 12 low and the high. So they'll look at the 11 low, 12 high, and try and buy at 50%, which is what they're doing right here. And that's what led to a second leg up. Bar 15, it's a double top with 12, or you can call it a double top. You can call it a double top with 7, bar 7, and this is a nested double top, or you can call it a triangle. It doesn't matter. But 15, 2 legs up, traders sold it. Now you have a bear bar on 16, but a big tail. Okay to exit shorts, exit longs below 16. Pretty aggressive sell, tight trading range. Better to wait for an upside or downside breakout. And then 17, breakout pullback buy. Reasonable buy, stop below the bar, betting on an upside breakout, which you can see it got right here. Buy the close, good follow through 18, buy the close 19, buy the close 20. 20 is problematic because it's testing these gaps over here where a lot of traders got trapped. So quite a few traders, they bought this low right here. They bought any of these lows over here. The market's testing back. So this should have been support. It broke below it strongly, and when it tests back in that price level, this is going to act as resistance. Therefore, there might be more sellers up here than buyers, but it's strong enough to expect a second leg. Therefore, traders will buy it and buy a pullback. 21, 22 consecutive bear bars, but this 22 failed to close below 21. So probably going more sideways than straight down. And I'm going to speed this up just a little bit. 24, some bulls bought 20, scaled in lower, getting out break even here. 24 is a second entry, but still, it's 2 legs up, and you may get at least a few legs down. Reasonable to exit longs below 24. However, on 26, now you have 2 legs down, leg 1, pullback leg 2. Traders will buy here, betting that you're going to get trend resumption, which the bulls are trying to get right here. Now we have a wedge, 1, 2, and 3, but it's a micro channel and it's fairly tight. You can also call it a parabolic wedge here. 1, 2, 3, but it's a micro channel, so if anything, probably 2 legs sideways and a minor pullback. And there's your 2 legs down. So credible wedge, 1, 2, 3, 1, 2, 3, so it's nested, but not a great shape and not ideal to sell. Big bar, big risk. Okay to exit longs, but if you do, you look to buy again. You don't buy here. Reasonable to buy here after 2 legs down. You can also argue a triangle, 1, 2, 3, 1, 2, 3, holding above the moving average since somewhere over here. So okay, buy, stop below here. And then you get a bull breakout, weak follow through, 4 consecutive bull bars, 4-bar micro channel, probably buyers below and at least a little bit higher. The bears will argue a wedge, 1, 2, and 3. But weak signal bar, so probably buyers below. Some traders will exit here, betting on a larger wedge and a bear bar closing on its low. And if they do, they might buy here. But again, when you have a wedge top like you do right here, 1, 2, 3, and a reasonable signal bar, expect 2 legs down. So this bar is outside up, and it might be a trap, and there might be more traders selling above the bar than buying. Outside down bar, strong enough surprise, probably at least second leg down. This is probably a trap though. Whenever you get a really big bar, there's probably more buyers below the bar than sellers. However, reasonable to look to sell a pullback betting on a second leg. So the traders buying this close are buying for a scalp. Not ideal. Most traders should look to sell or sell a pullback. But if you do sell, you have to understand the risk reward's bad. Stop up here, entry here, you're not going to get probably 1-to-1. Therefore, a lot of traders will look to sell a pullback, which is why this bar pulled back on bar 44, and then you got a second leg down. Bad follow through, so traders are going to expect bad follow through here. And you can see the market rallied back up to these highs. Here, another wedge, 1, 2, 3, but rather tight, and which means it's minor, so expect a few legs down. Some traders will sell this close, betting that you get a small pullback or a minor 2 legs down, but dangerous to sell here. If you do sell and you get follow through, traders exit, and you can see big bear bar, and you got 2 legs down. And for the bulls, they can argue a wedge, 1, 2, 3, but this is minor as well. Big down, big up, big down, in a large trading range, probably sideways, but holding above the moving average. And I'm going to just kind of speed up just a hair, but 2 legs down. At some point over here, the bulls clearly break above the range. They get follow through. This is a clear breakout of a trading range, with the trading range being this area. So you have a clear breakout of a trading range with follow through. It's buy the close until pretty much the rest of the day. And you can see the market rallied in the close. So it's buy the close, even this bar, but expect a pullback, and then you get 3 pushes up and the market goes sideways. Thank you for watching this video. I hope it was helpful. Comment below if you have any questions.